right, that's the RBI governor. That's good news. I mean, for macro watchers, Indranil Sengupta is head of research and economist at CLSA India. He's joining us from the sidelines of the 25th annual CITIC CLSA India Forum. Indranil, always a pleasure to have you with us here on the program. Thanks very much. This is good news. What you heard from the RBI governor, isn't it? The fact is, the last inflation print out of the US was also, it gave us the first glimpse that maybe things are correcting. And here, the comment from the RBI governor takes some pressure off the macros.
Yeah, so we are expecting 6.8% today, and we have been arguing for a while that inflation is peaking off. If you look at it, India's inflation has largely been driven by imported inflation from abroad, basically in terms of commodity prices and rain shocks. So money supply has been fairly tight. So we do think inflation will peak off to about 6.3% by March and 5.5% next year.
Okay, 5.5% next year, cooling inflation, of course, always a good thing. Indranil, good morning. The RBI governor also said that there is enough policy space now that the central bank has to use during times of stress. What do you think he's indicating towards, and what do you see as the RBI's next move now that inflation is cooling off?
So, we have been saying that the inflation imperative is kind of done. As you heard the governor, inflation, their acceptable inflation trajectory is somewhere between 4 to 6. Optimal inflation for India, I think, is around 5.5, and the policy rate is at 5.9. So now the further tightening by the RBI has to basically respond to the Fed. So we are looking at the RBI hiking to 6.75 based on our call that the Fed will go up to 5.25. But I think once the Fed is done, the RBI will cut fairly rapidly by 100 basis points next year, next fiscal.
But 5.25, the Fed gets to and stays there for a while, is what they're saying. And 6.75, right? You said here in India, which means another 100 basis points.
Yeah.
Right?
85 basis points.
85 basis points.
And then you cut back by 100 basis points because, once the market's price that the Fed is done,
right,
the dollar is going to peak off. And, so your the imported inflation problem that you have with the dollar weakening is going to go away.
Yeah. No, just one thing. So the war is still on, right? That was a big reason why commodity prices spiked up. And the other change at the margin is China, which seems to be coming back, reopening slowly. The first indications coming through, Indranil. That surely, things like oil markets, etc., will price that in, right? I mean, that puts upward pressure overall, because you said this is largely imported inflation, and the biggest of all is oil for us.
So there are two forces at play. First is, as you said, what if the war ends, China reopens, and so on. But there's also the, fact that Fed tightening is likely to push the US and Europe into recession. And historically, we have seen that when the Fed tightens, commodity prices do come off. So from that perspective, even we assume that commodity prices kind of stay flat, taking into account the pull and push. We think that inflation will come down to 5.5%, and that will leave enough room for the RBI to cut rates in the second half of next year. But, obviously hike right now.
Okay. Also, as far as growth is concerned, Indranil, there are certain barometers of growth, whether it's auto sales, cement sales, and we are seeing things pick up on the ground. In fact, a major commercial vehicle maker was telling us that there is fresh capex being put on the ground, because of which, the CV demand has gone up in a big way. What are you noticing as the big trends as far as growth is concerned, and what are you penciling in for not just FY23 but FY24 as well?
So we are looking at growth slowing to 5.2% in FY24 from 6.8%, maybe close to 7% this year. Primarily because once the US goes into recession, we think there will be a hit of at least 100 basis points on India's GDP. To be sure, India will still remain the fastest growing economy, but obviously growth has to come down all over the world if the two largest economies, the US and the euro area, get into recession. That is what we expect.
Anything in terms of expectations on China, Indranil, from your global team?
So we are looking at growth in China rising to 5% next year. But when you put that against the G2 recession that we expect, that's not going to really help from a global perspective.
And like the Europe and US proper recession, or you think
Yes.
short-lived?
We are looking at a contraction of 1% for the full year for Europe.
Okay.
For the US, 0.4%. So recession probably in the first half.
All right. And that should shave off some growth as well. And you're saying that China coming back on will not offset that in any meaningful degree.
Yes.
All right, got it. Sonia?
Okay. Any other, nuances in terms of growth? I mean, just coming back, you did say that growth will slow down to 5.2% purely because of the recessionary situation that the global market is seeing, and hence the kind of top-down impact on India. But bottom-up, are you noticing any improvement as far as the Indian internals are concerned?
So we did do a Diwali survey, something we do every year. And, there is obviously some improvement from COVID times. And, especially in urban India, I think, urban India has kind of put COVID behind. But rural recovery is still, limited. And in both in urban India and in rural India, in the lower income segment, there is still stress. So overall, we have a problem of demand, which seems to be persisting in the economy.
And that's something that companies have...
local level.
Yeah. No, companies have told us that as well, Indranil, across the board, across categories. Thanks very much for joining us. Good luck with the conference. Appreciate your time here on CNBC TV18. Thank you. The market is not making a